It happened quietly. No gunshots, no dramatic declaration, yet the financial world is reeling. On July 5, 2025, China, one of America's largest foreign investors, has halted all new investments into the US. This isn't a minor policy tweak, it's a trillion-dollar freeze, a financial earthquake. For years, Chinese capital quietly fueled everything from Silicon Valley startups to major infrastructure. Now that flow has stopped. No new Chinese state-backed money for American companies, ventures, or government debt. This is a full stop, a move with massive strategic and economic consequences. The sudden absence of this capital creates a vacuum, felt in boardrooms, on factory floors, and at kitchen tables. The news broke early, sending shockwaves through global markets. Investors scrambled for answers. What does this mean for stocks, jobs, and the economy? This is the most significant escalation yet in US-China economic tensions. The conflict has moved beyond tariffs. This is direct financial confrontation. Its consequences are only beginning to unfold. Why would China make such a drastic move? It's the climax of a year of escalating US-China tensions. After the US imposed steep tariffs in April, Beijing retaliated and trust collapsed. The investment freeze is China's new weapon: capital, not just tariffs. By withholding investment, China targets the US financial system directly, seeking leverage in trade and tech negotiations. Domestically, China faces its own economic challenges and wants to redirect capital inward. Political risks in the US have also grown, with Washington scrutinizing Chinese investments. The freeze is both a defensive maneuver and a power play. This signals a shift. The era of deep economic integration may be ending. Finance and politics are now inseparable, and their clash has global consequences. The world is watching as two giants battle for economic dominance. The impact is immediate, especially in high finance and big business. American companies planning expansions now face a funding gap as Chinese capital vanishes. Private equity firms like Carlyle and TPG, once flush with Chinese money, are scrambling. With fewer investors, borrowing costs rise, squeezing business profits and slowing hiring. The US government is hit too. China has long been a top buyer of treasury bonds. If China stops buying or starts selling, interest rates could spike, making debt more expensive for everyone. Taxpayers could pay more just to service the national debt, leaving less for public services. The stock market is already volatile, with companies reliant on Chinese capital seeing sharp declines. Venture capital firms are racing to replace frozen Chinese funds. Uncertainty clouds the business landscape, forcing leaders to rethink strategies. From Wall Street to Main Street, the ripple effects are real. The era of easy money is over. This trillion-dollar freeze will hit home, literally. Borrowing costs for mortgages and car loans are likely to rise, making big purchases less affordable. Businesses facing higher costs may slow hiring or even cut jobs, especially in sectors once fueled by Chinese investment. The job market could cool, with fewer opportunities and slower wage growth. At the store, imported goods may get pricier as tariffs and a weaker dollar take their toll. Even gas prices could rise as global markets react to instability. These small increases add up, straining household budgets. Your retirement savings aren't immune. Market volatility could shake 401(k)s and IRAs. Financial experts urge calm, but this is a wake-up call to review your financial plan. Diversification and resilience are more important than ever. The effects of this freeze will be felt in everyday life. So, what now? Experts agree. We've entered a new, more challenging phase in US-China relations. This freeze could be a negotiation tactic, China hoping to force the US back to the table. Or it could mark a long-term economic decoupling, with both nations building separate supply chains and financial systems. The US may seek new trade partners and push for more domestic investment, but filling a trillion-dollar gap won't be easy. The Federal Reserve and policymakers will face intense pressure to stabilize the economy. For individuals, knowledge and preparation are key. Review your finances, build an emergency fund, and stay informed. We're all navigating this new reality together. The road ahead is uncertain, but resilience and adaptability will help us weather the storm.